The Federal Reserve is once again changing interest rates. After a pause in June, the Fed raised interest rates by 1/4 point. This marks the highest benchmark lending rate level in more than 2 decades. Jen Sullivan explains what the latest raise means for you.
1 month after a pause, the Federal Reserve is raising interest rates once again to the highest level in more than 20 years.
We took another step by raising our policy interest rate 1/4 percentage point. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
On Wednesday, Fed Chairman Jerome Powell announcing its 11th rate hike since last spring. That's despite data showing the economy is holding up and inflation is softening. The latest consumer price index shows prices are cooling down. In June, that index rose only 3%, a much slower pace than the high of 9% the same month last year, which was a 40-year high.
Consumers are hanging tough. Part of that goes to the job market. Unemployment is very low, 3.6%. You've got to go back, 50, 60 years to see an unemployment rate consistently this low.
So, what does this mean for you? Economists say the biggest impact will be on borrowers because the Fed's benchmark lending rate impacts car loans, credit cards, and mortgages. For people looking for a home loan, this latest round of interest hikes means they'll pay more for their property. The historic series of interest rates have sidelined many would-be homebuyers, and there's no guarantee relief is coming anytime soon. Economists say more rate hikes could be ahead this year.
Inflation is still too high. The Federal Reserve is raising interest rates aggressively to slow the economy and get that inflation back down.
For Consumer Watch, I'm Jen Sullivan.